Okay. So 2.1, the sections of classified statement of financial position. So we're going to look further into the statement of financial position. Okay. And we're going to take a look at the different options, different elements. So first, what is the current asset? Okay, what's the current asset? We talk about assets, right? So what is the assets? So according to the definition of asset, it has three components in that definition. The first one is ownership, right? You need to have ownership in order to make it to be your asset, okay? If you borrow a car, okay, from a car dealership, and you use it for a month, that car is not your asset, right? You don't own it. Second, it's a past, it's a result of the past transaction. So you pay the money to obtain the asset. The last one, it brings cash flows. It brings future cash flows, okay? It generates future economic benefit to your company. Otherwise, it won't be assets, right? So what's the current asset? So basically, current asset would be something like cash, okay, and the short-term investment, accounts receivable, inventory, supplies, and prepaid expenses. So the reason why this is considered as current is that they can be converted to cash within probably 6 months or relatively short period of time. Okay, those ones are called current asset. So those assets can be converted to cash. Okay, so then you think about a short-term investment. If I purchase the 3 months GIC, right, guaranteed income investment, okay, certificate. So those ones will give me some kind of interest income, right? It's a short-term investment. So in 3 months, that asset will become cash, right? Will become cash. If you think about the accounts receivable, right? This is the money the customers owes you, but haven't paid you yet. Okay? But they cannot delay their payment forever. They probably have to pay you back within 1 month, 2 months, or 3 months. So this accounts receivable can be converted to cash when you collect this money from the customers. Inventory, right? You go to Canadian real store, right? You go to superstore, right? There are lots of inventories, right? How long do you think those inventories will stay on the floor? Don't tell me it will be more than 1 year. Many of the food will be, right, expired. So those inventories probably won't stay there for too long. Maybe 2 months, 3 months, not longer than that, right? So it was a bag of rice, right? I'm from Asia. I need a rice. Everywhere I need a rice. So a bag of rice sitting on the floor, that's the inventory. But within 3 months, somebody like me will go there, right? We're going to pick it up and pay the cash, right? So you can see that that inventory can be converted to cash within a relatively short period of time. So those are current assets, okay? So those will be the examples of the current assets. And machinery is that machinery in the factory considered as a current asset? Well, when you have a machinery, okay, can you convert that machinery into cash, which means you have to sell it within 3 months? You could, right? But you will not do it because when you buy a machinery, you buy it for long-term operation, right? You realize the benefit of having a machinery only because when you use it for long term, right? If you buy it and you sell it right away, you probably lose a lot of money, right? So in that case, machinery will be considered as long-lived asset. So it's non-current asset, long-lived asset. So that's the non-current asset. So also known as long-term assets. So student was asking about the machinery. Machinery is just the property, plant, and the equipment, right? You're going to use it for many years, probably. Long-term investment. If I, if I invested into a company, right, and I invested for a long time, so those will be my long-term asset. Intangible asset and goodwill. Intangible asset could be a patent, right? Did you know that Mickey Mouse, that picture, cartoon picture from Disney, their copyright will be expired very soon, this year. That means you can freely, if Disney does not renew that copyright, anyone can use that image for their benefit, right? So the intangible asset, something would be like a copyright, okay? Copyright, patent. So normally those ones are long-term, right? And it brings the benefit to the company. I mentioned about long-term investment. This could be the bonds, mortgages, all these different types of the banks, the debt securities. Okay, so basically, you give mortgage to other people, right? And they pay you interest. So when you have this long-term investment, so you lend your money to the mortgage borrower to pay back the mortgage borrower give you interest, right? So you make interest income. That's your investment. Equity securities, you purchase the shares of other company, right? So you get dividends, you get dividend income. So you earn interest income from the debt securities. You earn dividend income from the equity securities. That's the difference. And these ones are not normally intended to be sold in a short period of time. You need to hold it for probably at least multiple years. PPE, property, plant, and equipment. So this one would include land, building, furniture, computer, vehicles, right? These ones have a long-term value, right? So land, right? Land, it's the value of land always appreciate, huh? It's rare to see the land value depreciate. Goes down because if you see what happened in Canada, right? The land values, especially in Vancouver or Toronto, it just appreciate very fast. So what is the depreciation? Let's take a look. How does copyright bring benefit to the company? Sorry, I didn't see your notes. If you ask me a question, I didn't see it. Just use your microphone to stop me. Okay. So the student Randeep was asking, how does copyright bring benefit to the company? Okay, so the Disney picture of the Mickey Mouse. So let's say if I sell cap, right? If I put the Mickey Mouse picture on the cap, I probably can sell it easier than I don't have that image, right? So that image adds value. The Mickey Mouse image adds value, right? And the fact that you have the copyright, it protects you from protect you on that exclusive right to use that image. So if I use that image, you can sue me, right? So in that case, if anyone, if I want sell any product with the picture of Mickey Mouse, I have to talk to the Disney to make a deal with them. I have to pay them money to allow me to use that picture. Now you see why that copyright brings money to the company, because anyone wants to use it, they have to pay money to the copyright owner. You're welcome. Okay, so what is the depreciation? If you have a building, right, that's the PPE, property, plant, equipment, and that's your long-term asset, right? You paid $1 million, right? The building, but the building will be weared out, right? Year after year, right? So 10 years ago, you have a new building, you build it for $1 million, right? Everything's new. The wall, the roof, the floor, the paints, everything is new, right? 10 years later, right? If you didn't maintain it, your roof might be leaking, right? Your wall probably need to be repainted, right? So you can see the building will be worn out, right? So eventually, 50 years later, that building probably does not have any value, right? It's a piece of probably garbage there. Nobody wants to live there, right? So you think about that. What happened, right? You spend $1 million to build it at the beginning, 50 years later, and that building was too old that it does not have any value. And the value is zero. So what happened from 1 million to zero over the 50 years? So you can see that the value of the building declines over the time because it's just aged, right? It's worn out. So how do we recognize that? How do we recognize the declining, okay, the declining value of the building? Every year we use the building, right? A certain portion of the cost should be allocated, right? So in 50 years, you spend $1 million, right? That $1 million should be allocated into the 50 years of operating that building. You use the building, it generates revenue and income. But to use the building, it comes with expenses, right? It does not come with no expenses, right? In 50 years, that building cost you $1 million, right? Although that was all paid up upfront. You don't pay it year after year, but you still need to recognize that expenses, right? So in 50 years, you need to recognize that $1 million expenses. So that's called a depreciation expenses, okay? So it's an allocation and it's based on estimate. So basically, depreciation is the allocation of the cost of property, plant, and equipment over their estimated useful lives. Okay? So every year you recognize a portion of that, okay? And over the time, okay, that that allocation will be accumulating. Okay, so that's called accumulated depreciation. That tells you what's the total amount of depreciation has been recognized since the beginning. And the difference between the historical cost, the $1 million, and the cumulative depreciation, that's your carrying amount. So suppose this is $1 million for 50 years. So every year I should recognize 200,000, right? 20,000. Yes. So $1 million building, if you strictly evenly allocated over 50 years, each year you should recognize $20,000 depreciation. Let's say right now, this is the end of 25th year. Okay, you have used this building for 25 years. So now, what is the amount of the cumulative depreciation you should have? Anyone can tell me? Each year you recognize the 20,000, and right now we are after 25 years. What's the cumulative depreciation expense depreciation? So the building originally cost 1 million. The expected useful life is 50 years. So every year we are allocating $20,000, right? Yes, very correct, Arnaz. So it is after 25 years, you are accumulating the cumulative depreciation is $500,000, $500,000. So 20,000 times 25. And what's the carrying amount? So what is the book value of the building? So before it's 1 million, now the cumulative depreciation is $500,000. So what is the carrying amount? What's the value left? So you use 1 million minus $500,000. So the carrying value is $500,000. Okay, so we're gonna talk more about this in the future chapters. What time is it? Okay. So intangible asset, as I mentioned, copyrights, patents, trademark, licenses, right? These are the things gives you exclusive right to certain technology, certain images, right? Logos, whatever, right? Think about that logo, the Apple, right? Apple logo, the trademark, right? It has a value, right? It has a value. So those ones will generate future value to the company. And some of the copyrights, for example, the Mickey Mouse of the Disney, it has limited life. It does not have an indefinite life. So those copyrights need to be amortized because it can be used up at one point. Just like you do depreciation for PPE, you also do amortization for intangible asset, just to recognize the use, the consumption of the cost of the assets. Goodwill. What is goodwill? Goodwill has to be goodwill normally, okay? Goodwill normally result from the acquisition of another company. So why buy another company? Okay, I pay. So they have fair values, right? The company would have fair market values of their assets, liabilities. So I'm going to pay for that, right? No doubt. But on top of that, I pay them additional money, right? Because I think the company has goodwill. So that is the goodwill. So when the company's ownership was transferred from one shareholder to the other, and the new shareholder continued the company, and they paid extra money, so that extra money is the goodwill. Goodwill has indefinite life, so you do not amortize it. What is amortization? Amortization is kind of like a depreciation. You recognize the use of the asset because goodwill has indefinite life. So there's no amortization. Current liability. These are the liability you need to settle down within a year, right? Within a relatively short period of time. You cannot leave this. For example, you pay utility bill. If you have utility bill payable, you need to pay. You say, I'm going to pay you next year. That is not going to happen because they're going to cut off your power probably after 2 months or 3 months if you don't pay them, right? So those liabilities are current liability. The liabilities you need to settle within a year, okay, a relatively short period of time. Okay, so bank indebtedness, okay, accounts payable, deferred revenue, bank loan notes payable. So those are the things are called current liability. You need to pay it back, right, within a relatively short period of time. Non-current liability, okay, non-current liability, for example, a mortgage, right? So I have a house here, right? I have like 35 years mortgage, 30 years of mortgage. I don't have to pay back all at once. I have 35 years to pay off the mortgage, right? So that mortgage payable would be considered as a non-current liability. Lease liability. Sometimes you are leasing a building for 10 years to do business, right? So again, you don't have to pay off the liability right away. You have 10 years to do it. A little bit every year, right? Shareholders' equity has mainly two components. Share capital, like I mentioned, the company will issue common shares to the shareholders to receive cash, right? It could also be preferred shares. Return earnings, okay, that's the net income retained in the company for future use of the company. Okay, so we have 2 minutes left. Okay, so let me stop recording.